You're listening to the Wealth Mindset Show, where Hicks and Zerker Capital Management's team of finance professionals, portfolio managers, and a life coach come together to tackle complex topics in finance and retirement planning so you don't have to. From investment strategies and wealth management to tax planning, retirement income, and aligning your money with your values and purpose, the Wealth Mindset Show offers the tools to thrive.
All right. Hey. Welcome to Wealth Mindset Show, where our Hicks and Zerker team will have conversations on managing wealth, navigating retirement, and making smart decisions for a secure, meaningful future. I'm Austin Wilson, Director of Investments at Hicks and Zerker Capital Management.
And I'm Josh Robb, Director of Wealth Management at Hicks and Zerker Capital Management. Today, we are joined by Jessica Hinks and Chase Rose, two other advisors at our firm, and we're going to be talking today about building an investment portfolio for retirement.
And this is a loaded question.
This is.
Like, how do you do that? What are the process?
Yep.
What's the steps? I feel like we can go a lot of different ways here, but we're going to be answering questions like, hey, maybe should you adjust your investment strategy as you get closer to retirement? Or how do you keep growing your money without losing sleep? So let's start with just talking about the foundations of a retirement investment portfolio. So any thoughts on why investing in retirement is different than when you're investing during your working years?
Yeah, so we start with the biggest difference is during your working years, you're putting money into your portfolio, and then in retirement, you're drawing money out of. So it's a shift from contributions to distributions.
Correct.
Mm-hmm.
That's the biggest change between those two.
And the biggest concern for any investor has to be the bear market, right?
Yeah.
The inevitable dip in market prices. And so the biggest difference, as I'm sure you all know, and our listeners most likely know as well, when you're saving for retirement, that's an opportunity. Whereas if you're in retirement, it's pretty significant risk for a retiree to go through a bear market. So that's, the psychological aspect is much different.
So Jess, from a psychological perspective, how does that volatility feel different in retirement versus leading up to it?
Yeah, it's not a party anymore,
Right.
like Chase was referencing for people who are still saving. But for retirees, they probably spent 40 years growing and growing and growing a portfolio, and your sense of value can get kind of tied up in that, and your sense of peace, most importantly. And so when that volatility comes, your peace can just be shattered. But there's ways to restore that peace, protect it, if you do build a portfolio that's meant to navigate that volatility.
Yeah, that's a great point. So there's multiple aspects of these portfolios, right? They need to have some growth components, of course, because we know cost of living increases over time. So our money needs to grow. We also need to look at generating income, but also preserving our capital, which is really the most important part when it comes to volatile markets. And we're experiencing a volatile market right now as we're in a correction for the market, not a bear market, but a correction. So that's something at the top of mind for retirees in particular. Let's talk about some key components of a strong portfolio. So Josh, talk a little bit about that diversification between and across different asset classes and why that's important.
Yeah, and that really doesn't change for working versus retirement.
Correct.
Is we suggest you always have a diversified portfolio. Now, working versus retirement, your diversification may look a little different because you may be targeting different asset classes a little more in one or the other.
Mm-hmm.
For instance, you mentioned income. If someone's really trying to maximize income in retirement, they may focus on different areas of some of those, like the stock market or bond market. They may focus in on different pieces of that. So overall, both should be diversified, but how and where they're diversified may be a little bit different.
Mm-hmm.
Anything else about liquidity? So talk about a little bit about purposes for cash and how that can be important, but also not having too much cash that it's a drag.
Yeah, absolutely. So one of the biggest, recommendations we make for clients as they approach that retirement date, those last few years, obviously 401k savings is a great way for clients to save for retirement. But as we know, historically speaking, when you're saving into especially a pre-tax 401k, you're going to generate a lot of income tax when you inevitably take that in retirement. So something we often advise, as long as the situation allows for it, just start stacking cash those few years before retirement, because not only are you going to have the cash available where you don't have to worry about what is going on in the market, but you can keep your income tax pretty low. You can keep your tax return is going to be much easier.
Yeah, I say that all the time to people on the on-ramp to retirement, that I've never met a retiree who regretted having cash. It just doesn't happen because it helps you have peace. It helps you navigate volatility. So if you're already meeting your 401k, your Roth IRA savings goals, start hoarding it up those next few years of retirement. That's honestly my recommendation.
Yeah, and that's a really big point as well. Something that I feel like people, it's hammered into people when they're young just to save for retirement, right? And doing something is always better than nothing. But if we were to work with a young person, I think a common recommendation piece we would have, or a piece of advice would say, diversify not only in your investments, but in the tax, the way in which you save, right? So you can use vehicles like 401ks, Roth IRAs, and brokerage accounts, and any other accounts that are out there. Those are just the most common ones. Because when you have flexibility in how you take your money in retirement, that can optimize retirement. It can optimize things to such another level that you wouldn't have had before.
Yeah, there's three. There's after tax, which is that taxable cash, investment. There's pre-tax, which is usually your traditional 401k. Then after tax, which is the Roth piece. And so all three of those are taxed differently, which allows you flexibility.
All right. So next, let's talk about adjusting your portfolio as you approach retirement. So this is common knowledge that people tend to think is, hey, I'm getting close to retirement. I need to be less risky. Or, hey, I'm in retirement. Maybe I should be really conservative. And that's not always the case. And I'm sure Josh is going to insert his his favorite term, it depends sometime in this conversation. But let's talk a little bit, about adjusting that investment philosophy as you approach retirement. So is it a time to adjust your investment approach?
Well, it depends. Look at that. But the on-ramp, Jess mentioned kind of that on-ramp, those years before, part of that piece is, and we've talked about this in some other episodes, is that early part of retirement, you're most vulnerable to market movements and how that impacts your success. And so there is some to getting a portion in a nice conservative piece. We've talked about it as kind of a bear market fund to protect against market volatility for a couple years worth of your needs. And in doing so, heading into retirement, you remove a piece of that sequence risk, the risk of, oh no, those first couple years aren't as good in the market as I needed. And so from that standpoint, yes, you do see some people heading into retirement take a portion of their portfolio and maybe reduce volatility. But the overall is, if you're retiring in your 60s or 70s, you have a long-term time frame and you still have the biggest challenge, which is inflation, to fight against. So you really can't go very conservative if you hope to have that long-term success.
And I think that's a common thought is, I'm retired or I'm nearing retirement. I need to really protect my nest egg.
Yeah.
And I think that often actually burns people more than they think, because you just mentioned it. That big ticket item that we're trying to outpace is inflation. Inflation is always there and it erodes your purchasing power over long terms. And fixed income has its place, as we're going to talk about, but it does not do nearly as well as stocks at outpacing
in the long term. Yeah. And that's the thing is, what am I protecting against? The short-term volatility, the stock market going down this year, or my purchasing power? Can I buy the food and everything I need 30 years from now? That's the bigger risk. But not as many people think about that risk versus the market on the TV is down. I should be concerned about where my portfolio is at this point.
So Jess, talk a little bit about the role of bonds, the role of fixed income, that sleeve in an investor's portfolio as they get closer to retirement and into retirement, how important that is, and if they're even really relevant for most people.
Yeah, like Josh mentioned, retirement is such an important part of an investor's life. And I just think it's a stage. A lot of us don't just step back and think about our asset allocation or stock to bond ratio. We wait for certain life events to happen, whether it's a job change or retirement being the biggest one. So it's just a good time to prompt the conversation and also just prompt the debate of where bonds belong in your portfolio. They still absolutely deserve a place. You really have to look at your financial projections you've created with your financial advisor, because if you don't need to have your pedal to the floor on risk, you shouldn't be targeting an 8% return. You shouldn't have to put yourself through those sleepless nights if you really don't have to take on that kind of risk. So if your risk tolerance doesn't support that, or if your success in retirement isn't dependent on high returns. Bonds absolutely deserve a place in your portfolio to bring stability and peace of mind and to provide for those kind of first few years of cash flow or during emergencies.
I would also add that if you need those super high returns for your plan, first of all, you either have really high expectations,
or you're not ready to retire.
Yeah, or you're not ready to retire, and you need to postpone this, because typically it is probably a good idea to be taking some of those super high risk, super high beta allocations down as you get into retirement, because those are the things that can really just either tank or really suffer overall for your portfolio. So that's an opportunity there. But one thing that we really advocate for in retirees' investment planning and their portfolio management is dividend income in general as a diversifier within your stock portfolio, because a lot of the big stocks don't pay a very good dividend. So if you have a portfolio that pays a steady stream of income that's growing over time, those are often less associated with high volatility areas of the market. They're a little bit more stable, steady as she goes, kind of blue chip companies. And those are something that clients can get equity exposure, which has a better return over the long haul, while taking less risk than buying something that's more like the S&P 500, which, as we know right now, is pretty growth oriented. It's a little bit more risky. And that's something we've been advocating for, and we've had clients do really well with that over time.
Yeah. Absolutely.
And it also gives you, so let's say you got a 2% return on your investment, that's 2% of your need as well being created from your investments. And so from a total return approach, you're going to sell some of those that appreciate, but you have to sell less because it's also generating income. So it just gives you another way of creating income within your portfolio.
Let's talk about asset allocation in terms of not what you're buying. This may be location. Let's talk asset location. So let's talk about different account types and types of portfolios and the buckets that you can put all those in to know where to pull from what over time. So how do you guys manage that with clients?
Yeah, well, first and foremost, we kind of mentioned it earlier when we are recommending that a client just stack some cash before they retire. You want to make sure that cash is liquid, right? There's no point in accumulating cash in a Roth IRA when you know that might be one of the last buckets that you touch.
Right.
And then that's another point that we can maybe get to in a little bit as far as what you should be accessing first. But you definitely want to keep your most liquid assets in the most liquid tax accounts. Just think about your IRAs. Your IRAs are generating income, so it's one step less liquid than just an after-tax brokerage account. So we want to accumulate a little more conservative assets because they're also, generally speaking, going to accumulate less income and in turn, less tax over the long term. So you want to reduce your tax exposure. But also those IRAs and the Roth IRAs, they're going to grow tax deferred. So if you have more aggressive strategies, especially long term, you're going to be a lot better from a tax perspective, having your more aggressive strategies there.
And to build on that, we're talking about asset location. You really need to think about, what are my next 1 to 4 years of expenses? They need to be conservative, preferably in a brokerage account if that's what you're living off of. But what if you're RMD age already, so 73 plus? Then perhaps your conservative assets need to be in your IRA. So it not only does it matter that you're retiring, it matters at what stage in retirement are you? Are you at the age where you have to live from your IRAs, or aren't you? Or do you even have a brokerage account at all? Because some people don't.
And that brings up another discussion of other income sources that you can factor in on your liquidity needs at any given point in time. Maybe you've got a pension. Maybe you have pension from a spouse who passed away that you're still able to receive. Maybe you're receiving Social Security. You have some rental income on the side. How do those factor into that whole picture?
Yeah, and that's a piece. When you look at your retirement plan or you're working through kind of when can I retire, one of those pieces is how much do I need in retirement? And that's a spending number. And then once you retire, you have income sources, and then the difference between what I spend and my income is what the portfolio needs to provide. So how you factor in all your income is to say, okay, one, is it growing? So Social Security has a cost of living adjustment. Not all pensions do. And so the question is, and rental income does probably periodically, you raise your rental prices. So how does that affect my needs over time? And then you say, okay, my portfolio needs to cover the difference. And so I need to invest a way to make sure I'm getting that return.
Yeah.
The difference between my income and my expense.
And typically when we're building the retirement plan, one of the first things we're doing is we're identifying what their goals are, what their needs are in retirement, right? So let's say, just for the sake of round numbers, let's say someone has $5,000 per month in needs from their portfolio. Well, let's analyze what their fixed income sources are. By the time they get to the retirement, their fixed income is what it is. There's not a whole lot you can do about it at that point. So whatever that difference is, that's where we start the conversation about how aggressive or how conservative do you need to be? And this right here is oftentimes why I like to say that financial planning is an art, not a science. It's not going to be the same for everyone. And oftentimes we have clients who come in and say, hey, I talked to, XYZ advisor, and they said, because of my age, I need to be 60-40 or 70-30. Well, I would say that is a very blanket statement. We're in a highly regulated industry. So a lot of times people are saying that just to protect their butt. But to that, I would say, let's focus more on what your needs are, right? So let's say if you need $3,000 a month from your portfolio, that's going to be a different withdrawal rate and in turn, a different asset allocation for one person than it is another.
Yeah.
Right.
Based on the balance you have. Yeah.
Exactly. If I need 4% of my portfolio a year to cover my expenses, and that dollar amount is going to be 1% from someone else, well, you can be a totally different, and your investment philosophy can be totally different for both people. That's why it's definitely not, it's not a cookie cutter type of thing.
I think that's why things like target date funds are risky, because every situation is so different, but those are not, right? Those are based on a number and an allocation to get you to a date, but every person's need is different. Every person's how they want to look at things and understand and pull from different things is different. I mean, we've got clients in their 80s who just are not bothered by risk, right? They might be 100% equities, but we've got clients in their 50s who are very risk averse.
Yeah.
And they may be very conservative in their investments, but those would not be the standard, the industry standards that everyone talks about, where they're like, oh, you need to get less risky as you get old. That's not necessarily the case for everyone. Sure. And that's definitely, we have some examples of that.
Have you ever felt overwhelmed by the complexities of managing your wealth? At Hickson Zerker Capital Management, we specialize in helping affluent families and individuals navigate the complex challenges of managing their finances. Wealth management is all about combining thoughtful financial planning with active investment management to help you reach your goals. Our process is designed to guide you toward what truly matters, because we believe wealth isn't the destination. Achieving your dreams requires careful planning, smart decision-making, and access to high-quality investments. That's where we come in. We understand that complex financial situations call for deep expertise in investing, tax strategies, and retirement planning. But our approach goes beyond that. We integrate your financial goals with your core values, helping you visualize the possibilities your wealth can create for a secure future. If you're ready to take the next step, visit hzcapital.com/start. Again, that's hzcapital.com/start. Now let's get back to today's episode.
So that brings us to a great discussion on that income, that difference that you're trying to generate from your portfolio. Having a withdrawal strategy, as you just mentioned, super important. You kind of can calculate where and when that should come from with your advisor, but let's talk about the 4% rule, because that's what everyone talks about. You can withdraw sustainably 4% from your portfolio forever and you'll never run out of money and you should be fine. Is that true today? And does it still work? Is that what we recommend? I don't know. What do you guys think?
It depends.
Oh,
yeah, thank you.
There you go.
You
Just
filled
be
in for
Josh
me.
to it. Yeah.
Did you just think of that?
In the end, this was based off a lot of research, and it was a initial withdrawal rate of 4% would cover a 30-year retirement. That was what they based all the research on, and they looked at different market cycles, and it gave them a high probability of success. Is that still true? It depends on your asset allocation, and they were using 60%, 60% or higher of equities. Higher equities you had, the more success you had on these researches. But that's the big thing going forward is 30 years the right number? And I think that's, of all the things they used in their calculation, that's the thing that's changed the most since they've done this research, is people are retiring in their 60s, but they're not living until their 70s, 80s. Now they're living into their 90s or over 100.
Right.
And so you're extending this time frame. So this 4% rule becomes interesting. It's still a good rule of thumb. It's still one, if you just wanted to do some math on a piece of paper to say, where am I at? It's useful. In the end, is it right? It really just depends on where they're at, what age they are, and kind of what their withdrawal is to see how much pressure is that. Do they have flexibility? Is this like, well, if I take 4%, I got plenty of money and I can do a lot of fun stuff, but if things get rough, I can cut back? Or is like 4%, I need this to live on and I can't go any lower? Because those are two different lifestyles of a 4% withdrawal.
Well, and that brings us to a discussion of the way we often implement this with clients. We don't typically just say 4% is your number. We bring in what's called a guardrails approach.
Yeah.
So can you explain that a little bit too?
Yeah, so the idea there is you have a withdrawal rate, And usually it's higher than 4% because we have some rules based around it. But the idea is you have a starting withdrawal rate and you increase it with inflation like you would need to over retirement. But in years where the market doesn't do well and your portfolio drops, if your withdrawal rate hits a certain threshold, then you are asked or required to reduce your spending by a certain percent. And then on the other side, if it does well, you get to give yourself a raise or a bonus to increase your spending. And so guardrails, think of it just driving on the highway. There's the barriers on each side that keep you from going too far, right? And that's all they are. They're trigger points on either end, good or bad, that says, hey, let's make an adjustment. Some things have happened that have changed since we initiated this. Let's make an adjustment. Yeah.
And one reason I actually think the 4% rule is actually too conservative is, I've seen dozens and dozens of people retire and live from their portfolios, and they don't ask for raises very often. We always say like, guardrails, you can get a raise every year with inflation if that happens, if the portfolio's performed well. But more often than not, retirees seem to slowly spend less, not counting inflation, over time. And they seem to just absorb that cost into their inflation because, kind of slowing down year after year. And for that reason, I think that your initial withdrawal rate can definitely start above 4% if you choose a careful number with your advisor, you monitor your withdrawals every single year, and then you maintain a place of flexibility to where if they tell you need to cut back or something, you have the ability to do so.
Right.
So
it's usually see it like in real life, 3 to 5 years, retirees every 3 to 5 years say, let's make an adjustment, and it's, everybody likes round numbers. It's not, a 2% inflation adjustment just gives you weird withdrawals. And so a lot of times they say, hey, I was taking 5,000, 3 years later, they say, let's go 5,500, right?
Exactly.
And so it kind of averages out, but in the end, you're right. It's not a year-to-year thing.
And to your point, Jessica, the real reason why we're trying our best to get our clients to identify what their real spending is, because that's primarily what we're planning around. We know that if we have income sources that might start later, you can have a withdrawal rate initially that's much higher than that 4% rate. Now, obviously, you're not going to be taking 20% of your portfolio per year, but if we know that your spending is $5,000 a month, but you have this $2,000 pension that won't start for another 5 years, as long as, our research and our analysis shows that you'll have a successful retirement, we can be comfortable with those higher withdrawal rates early on, knowing that fixed income will replace it later on.
Yep.
So that, again, Austin, is why it just depends.
Just depends.
Exactly.
See how that
All
works?
right. Ready for the hot topic of the episode.
Yes.
Dividends and income-only distributions versus selling investments, so capital gains, right?
Yes.
Some retirees are very adamant that they only want to take the income off their portfolios. And there are lots of ways we can do that. We can do that with, dividend-paying stocks and ETFs or bond ladders or all kinds of things. Or we can use a total return approach where we are essentially harvesting gains as we go and just taking it off out of the portfolio as a total rather than just the income. Talk about the pros and cons to both of those and how we've implemented it with clients.
I'll kind of start with saying I think the dividend and interest-only approach creates a scarcity mindset. I think you only get $2,000 a month of dividends. That's all I can live off of. And you're just really partitioning off your entire portfolio, which is your wealth you should be enjoying and living off of.
You save the principal up your entire life.
And then when
that's growing.
Exactly.
Yeah,
Yeah.
exactly.
Really,
These are for my kids.
Yeah, if they have like a legacy goal, then something like that may make sense.
Right,
but you're right, is you're going to leave potentially that same amount of money at the end or bigger.
Hopefully appreciate it.
If it's growing. So is that your goal? Is that what you're trying to achieve? Are you leaving stuff on the table that you could use for your own benefit?
Yeah. And I feel like the dividend and income always ties back to, at least me personally, a tax planning conversation, right? The dividend reinvestment strategy might make sense for one account as opposed to another. So just think about if someone's consistently withdrawing from an IRA, and let's say you're using that dividend reinvestment strategy, you're not incurring capital gains when you're buying the dividend back that got paid out or buying the stock back that paid out a dividend and selling that for a short-term gain later. Whereas in a brokerage account, you might be. So if you're consistently withdrawing from a portfolio, it's really important to know which account you're taking from before you make that decision.
Yep.
But the stats would say, and I'll let you allude to this, Mr. Wilson, as the portfolio manager, dividend reinvestments definitely perform better over the long term.
It does. So if you look over the long term, if you reinvest dividends versus taking it out of the portfolio, your portfolio essentially over a 30-year period is actually having about double the performance.
Exactly. Yeah.
And that's a lot.
3 out of every 4 years is positive.
Right.
So even along the way, if you're taking withdrawals, if you're putting and reinvesting the money, a lot of times just that
It's still growing.
difference between timing gives you a little bit of growth on that.
And the total return approach allows for natural rebalancing.
Exactly.
If you're only living off dividends, it can be really easy for your portfolio to get out of whack. But if you're selling things, you can choose what needs sold purposefully.
And when those dividends are paid out, they're sitting there in cash waiting to be reinvested. You'll have some underweight positions that you can kind of buffer back up so that the opportunity is better in the future too. So,
all right, last topic. Mistakes to avoid in retirement. So any examples of some of the biggest missteps that retirees have made as they're planning for or getting into retirement with their withdrawals and stuff like that?
Yeah. The biggest one we hit at the very beginning is too conservative versus too aggressive, right? And you actually are not going to know the answer to that till the end of your life when you know all the returns and you know that sequence. Then you could have known exactly your withdrawal rate to go to zero at the end. We don't know that. But the question on the front end is always, how aggressive do I need to be to meet those goals, like we talked about earlier? Then how much aggression can I tolerate? And we got to get as close for those two together to meet the needs without going too much past your tolerance. So too aggressive, too conservative is a mistake we see on either end because you don't want to run out of money. You also don't want to leave a bunch of money if that's not your end goal. You want to use it.
One of the biggest mistakes I've seen is just people not planning ahead for major expenses early in retirement. People retire, and the next thing you know, they're buying a lake house or they're buying an RV, big cars, and they knew in their heads they were probably going to do it. They just didn't prepare for it. So next thing you know, you're taking hundreds of thousands of dollars out of an IRA in one tax year, right? But if you just planned ahead a little bit more, put some cash aside, it would have been so much less painful.
Yeah, absolutely.
I think taxes are something that is overlooked a lot. That looks very different when you're withdrawing money than when you're making money. And planning for that appropriately is obviously key. But obviously, and that also goes into the other side is also true, being over-focused on taxes, where it's good to focus on taxes, of course, and you need to plan for that. But letting that drive your investment decisions can be very, very tricky as you're trying to navigate those. They're murky waters, right? Yeah. There's no right or wrong answer that's the same for everyone. You have to work what's best for you with your advisor, but I feel like both sides of that are also true. Like too focused, not focused enough, and both can be critical choices.
Yeah, we work oftentimes with a CPA who our clients utilize, and his perspective, honestly, I come to appreciate quite a bit. As a tax advisor, his perspective is don't let taxes prevent you from making a smart investment decision. And that's how we invest money here. We are aware of taxes when we're making a trading decision, but we do not let taxes dictate a move, because if we think that a stock is going to outperform in the future, that's obviously the change that we're going to make despite what the tax implication is.
Don't let the tax dog wag the investment tail.
Exactly.
Is that right?
There you go. Yeah.
All right. Well, as we would always recommend, this is a great opportunity to talk to your advisor. Check in with them about your preparation leading up to retirement or withdrawal strategy, everything we talked about today. But this is just a great opportunity, whether it's us or someone else, talk to your advisor. And as we mentioned earlier, we're in a little bit of a volatile market. So this is a great opportunity to look forward, look past the current tariff drama that we're having right now and the current sell-off that we've gotten in the correction territory for the S&P 500. It's just an opportunity to keep a long-term perspective with your investments here. But I guess any other key takeaways?
I think working with an advisor, because the advisors who, and I say this almost just a little bit biased, as I feel like we do a good job here at Hicks & Zerker, but the advisors, the way we build our portfolios, we're aware of, what investments we're putting our clients into, whereas, a general, Joe Schmo is walking down the street might be invested in the S&P 500, but he's not fully aware of what he's investing in, because there's a lot of companies in that index, just to use that as an example. But also having someone who can plan for all of the other areas of your life around those investments. How do you use the investments as a tool to unlock the other areas of your life, right? So there's a lot of other conversations to be had. Investment planning is just one piece of the puzzle. You have tax planning, you have healthcare planning, which is big for retirees, and that's just one piece of the puzzle. So working with an advisor who understands all aspects of your plan can unlock a lot of potential in your financial life.
Yep. And have a good plan. A good plan you can make tweaks to, but it shouldn't have really large dramatic changes. And then be flexible because, again, there may be some opportunities for you. There may be something that you had on your bucket list that comes up. Flexibility is really important in retirement because you want to enjoy that. But understanding the trade-offs, that's really all it comes down to in all investment planning, but especially for retirees. Once you kind of stop your income and contributions, you're just weighing opportunities versus others. What am I trading off for this or that?
I think investing for a retiree comes down to just asking your advisor 2 questions, which is, how much can I take a year from my portfolio? Simple as that. And 2, how can I be invested in a way to best support those withdrawals?
Yep.
And that's really all it comes down to.
Yeah. Yep. Absolutely. Well, thank you guys for listening. Thanks for the team for being on this episode today. If you found value in our conversation, don't forget to subscribe to the Wealth Mindset Show on whatever podcast platform you're listening to so you never miss an episode. Also, visit us at thewealthmindsetshow.com for more resources. And if you're ready to invest with us, if you're looking for an advisor or just a second opinion, head over to hzcapital.com and check out the Invest With Us tab there. And we invite you to follow us on all of our social medias. We are pretty active on there so that we can stay connected. Otherwise, thanks for listening, and we'll see you next episode.
Talk to you later.
See you later.
Thanks. Bye.
Thank you for joining us at the Wealth Mindset Show, where we tackle the complexities of finance and life planning to help you align your wealth with your values. We hope today's conversation provided value and clarity as you navigate your financial journey. Your hosts work for Hickson Zerker Capital Management, and all opinions expressed by them or any podcast guest are solely their own and do not reflect the opinions of Hickson Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hickson Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment, and any investor attempting to mimic index performance would incur fees and expenses that could reduce returns. Securities investing involves risks, including the potential loss of principal, and there is no assurance that any investment plan or strategy will be successful.